There we go.
All right, welcome to today's webinar. Ryan Fisher here with Paul Moore. Just a quick disclosure, Camaplan does not endorse, give any tax, legal, or investment advice. Please do your due diligence, consult with your accountants, attorneys, and other professionals. I can be reached at Fisher with a C there, RFISCHER at camaplan.com. I can help answer any questions about using your qualified funds to make investments. I can be reached at 215-283-2868. And we'll just go ahead and hop right in. Welcome, Paul, and thanks for being with us today.
Yeah, great to be here, Ryan. Thank you so much. So you can all see my screen, right?
Yes, sir.
All right, fantastic. So a little disclaimer, we're not soliciting you to invest with us, and we can't promise any of the returns in the case studies will be true ever again, as you can imagine. So yeah, I'm Paul Moore. I've written a couple books on commercial real estate investing, and I've been honored to be a guest with Camaplan probably 5 or 6 times at least right now. My history is kind of funny because I actually, I got an engineering degree, and then I got an MBA, and my MBA was in finance and operations and logistics. And so after I graduated, I went to Ford Motor Company and worked in their parts and service, which is their warehousing and light industrial division. It's now called the customer service division. And so I feel like I have a little background in what we're going to talk about today, but most of my background is simply through the fact that our company, Wellings Capital, has a diversified fund where we invest in lots of different asset classes. And I've talked about other ones on here before. One of them was multifamily, and I wrote a book called The Perfect Investment about multifamily investing. My journey after I sold my company to a public firm in 97, 25 years ago, was I went through single family flips and rentals, and then I did waterfront lot rentals, and then waterfront lot flips, I should say, waterfront rentals, built 7 or 8 homes, did a small subdivision. I was always wondering, Ryan, how do I get involved in commercial real estate? I wasn't sure where the on-ramp was. Well, our company built a multifamily asset in North Dakota, and we managed that for a number of years. I eventually wrote this book called The Perfect Investment, but as I've shared on other webinars with you guys, the perfect investment isn't perfect if you have to overpay to get it. So I was looking for the perfecter investment, and I found that in other asset classes like self-storage, and I talked about self-storage on here before. I've talked about mobile home parks on here before, but today we're going to talk about light industrial. And we would not have thought about investing in light industrial because in general, our company is looking to find asset classes that have a lot of mom and pop owners and that leave a lot of meat on the bone, a lot of upside available. And you wouldn't expect to find that in industrial. It sounds so corporate. It sounds so institutional. But today, what we're going to find out is it's not at all what you think. Light industrial is not always institutionally or corporate owned. It's not as industrial as it might seem. Now, before we jump into light industrial today, we're going to talk about the largest user of warehouse space in America. And of course, that is our friend, Mr. Jeff Bezos. Now, Jeff Bezos found this amazing thing when he went public. He found out that if he could save or make $1, it could multiply his returns, his wealth, and his investors' wealth. Now, and the reason I'm going over this is because this is the same way commercial real estate works. But I'm going to talk about Jeff Bezos for a minute to make the point. So he went around all the Amazon facilities in the US and he reportedly took the light bulbs out of all the vending machines. The Lance snacks, you know where it says Lance at the top? He took the bulb out of there, and his logic was, why waste that electricity? Why waste the maintenance person's time to have to replace the light bulb and the cost of the light bulb? Why should I do that just to advertise Lance Snacks? Everybody can see this as a snack machine. And so by doing that, it just kind of reminds us of his mindset. That's if he can save $1 a month, that turns into $12 annually. Pretty good math, huh? But at Amazon's price to earnings ratio, that puts a total, that $12 annual savings at a price to earnings ratio of 60, which is around where it's been lately. That's a $720 value in his wealth and in the wealth of the Amazon stockholder. So the power of a single dollar per month, $12 per year, is $720 in value. Commercial real estate works just the same way. And I think that's why the Forbes 400, the wealthiest people in America, almost all invest in commercial real estate. Here is a little illustration about how it works. Now, if you save $1 or make $1 per month in commercial real estate, that's $12 per year. That $12 per year is divided by the cap rate, which is sort of like the inverse of the price to earnings ratio in the stock market that you might be familiar with. So $12 divided by 0.06, or a 6% cap rate, is a $200 asset value. But that's even more in your pocket if you're leveraged at about a normal debt ratio of about 66%. So that means it's a 3 times impact on your equity. So that could be a $600 equity increase just by saving or making $1 a month at the asset level. It's very powerful. And the reason I'm bringing this up is many of you and I have certainly invested in single family residential where it doesn't work that way at all. The value's based on comps. I've got a friend who had a $1.7 million Gatlinburg cabin. And just in the last 5 months, since the recession has set in and interest rates have skyrocketed the value of his cabin, he said, I'd be glad to get $1 million for it today, because it's based on comps. It's based on comparable properties, and the comparable properties in Gatlinburg have gone way, way down. Now, it's possible that the cap rate could also expand and cause commercial real estate property values to change as well. But here's the difference. That guy in Gatlinburg has virtually no control over the value of his property going up or down. It's just based on comps. We have some control because we can do something called forced appreciation. Forced appreciation is when you create more income by taking actions at the property level. That increased income, again, run through this grid, results in a significantly leveraged increased value in your pocket. So I'm going to go over some examples. These are just for commercial real estate in general. So if you fill 15 vacant apartments at $825 a month, that's $12,375 a month in additional income. That's nice. That's $148,000 a year in additional income. Divided by a 6% cap rate, though, that's $2.4 million in increased property value. Or if you save $35 per month on water bills times 125 units, that could be a mobile home park, that could be an apartment building. That translates to $875,000 in value. At a mobile home park, if you raise the lot rent by just 5%, that might be $15 a month. Take that across 300 lots, and you've got an increase of $4,500 a month in income, $54,000 a year in income, but almost $1 million in increased value of the property. Other things you can do, you can negotiate a cable internet deal. You can spend $100,000 to add paid outdoor storage. You can add U-Haul at $3,000 a month on U-Haul can translate to $600,000 in increased value of a self-storage. There's a lot of other things you could do as well. And so we love commercial real estate because we can force appreciation. Forcing appreciation means that we're not at the mercy of comps. We're not at the mercy of the market. We're not at the mercy of cap rates. but there's a problem with forcing appreciation. The problem is commercial real estate has been so popular for the last 12 to 14 years, especially since the Great Recession. And so many people have gotten into it that it's hard to find deals that aren't already optimized. It's hard to find properties that haven't already had the value add done. That's the challenge for you and I as investors right now. Where are we going to find properties? Where are we going to find asset classes and assets that haven't already been optimized? The answer is by finding assets that are owned by mom and pop operators and acquiring those. And I've talked on previous webinars about finding assets in the realm of self-storage that are mom and pop owned and mobile home parks. And today I'm going to talk about light industrial. What a surprise to think that a whole lot of light industrial properties would be owned by individual owners. And a whole lot of those individual owners are mom and pops that don't have the desire or the knowledge or the resources to improve their property, increase income, and maximize shareholder value. Now, this slide shows the net operating income growth of all these different asset classes. And you can see this is the projected growth from 2020 to 2025. Manufactured housing is at the top of the heap, but industrial is second. We love investing in manufactured housing. We love investing in industrial. We love investing in self-storage and apartments. All four of those top asset classes we like, but we like industrial and manufactured housing more than apartments, honestly, even though I wrote that book, because there's usually a lot to be done to improve the property upon acquisition. Now, like I said, increased income results in increased pricing. This is a chart showing the appreciation just since COVID. Industrial pricing, this is March 2021. So in 1 year since COVID, till this Green Street put this chart out a year ago, there was a 14% increase in pricing of industrial. Manufactured housing, mobile home parks, storage, apartments. Apartments at the time of this chart were actually down briefly, but they've come back up since. But industrial is the top increase. This chart, again, shows the same thing. On the left, what we've got is the Green Street commercial property price index. And we've got manufactured housing at the top, industrial second, self-storage third. On the right there, it shows the change in private market values since COVID to the time of this publication. Industrial was the top change, 41% increase. 41% increase, and self-storage is second. And if you think about what happened during COVID, you can see why. I mean, the retail sector got pounded while people were staying home, but a lot more people were ordering everything, including their groceries, to flow through the supply chain and flow through the types of assets light industrial uses. And so there's, for a lot of reasons, light industrial has gone way up. This is the projected growth, 2020 to 2025. Industrial is at the top of the heap according to Green Street in these asset classes. So what is small bay light industrial? What are we going to talk about today? Well, the industrial real estate asset class can be divided into three major sectors. There's small bay, there's mid bay, and there's large bay. Light industrial is a term that usually describes the small bay facilities. Due to the infill location, which means they're typically, they might be right by a neighborhood, or they might be right off an exit, at your off the highway in your city. These are typically in flexible zoned areas. They're not like in heavy industrial. They're not necessarily in a neighborhood. They're sort of right between. They might be right by a town. And they were particularly resilient in downturns like COVID-19 And we believe they'll continue to be resilient. So small bay industrial is usually less than 200,000 square foot bays, and they might have 20 to 200 tenants in an industrial park. Okay. And so if you think about an industrial park, if you think about last time you went to one, you might have had the same experience I did. I couldn't find the place I was looking for. It was poorly marked. Honestly, the landscaping was outdated, a little bit overgrown. It looks like the windows were from that 1980 bronze look, like they look like, the halogen or the argon or whatever's in the window had not been maintained very well. Some light industrial is not well managed. And here's why. If you look at the right, you see US industrial as a whole. Larger industrial is only has 23% owned by private owners. And it has private equity, institutional REITs own the majority of this. But go over to the left and you got multi-use logistics. That's what we're talking about here. The ownership is 55% by private owners. So you may be surprised to know this, but over half of the industrial parks that we're talking about today are owned by private owners. And a whole bunch of those private owners are mom and pops. They might have built this industrial park in the 60s or 70s or 80s. Their parents might have built it. They might be second generation. It might have fallen into disrepair. About a year and a half ago, I was looking for office space for our company, Wellings Capital, and I went into this light industrial park. I walked in the space. The broker said, the key's hidden over here. They hid the key for this thing. The broker didn't even meet me there. I walked in, and first of all, it smelled stale, like nobody had been there for years. And when we looked around, there were old telephone systems on the floor. There were file cabinets. There were thousands and thousands of file folders everywhere. There were those old brackets that hold the file folders in. There were old desks. There was an old phone. There's like a $700 conference phone back in the 90s or whenever it was purchased, and now just sitting on the floor. And I called the broker. I'm like, is this how it's going to be? I mean, and the offices were all set up too, and it had really old, stinky carpeting. He's like, yep, that's how it is. You can probably use those file cabinets. Well, that's all I needed to hear. We locked it back up and left because we couldn't picture being there. We couldn't picture being in that office space and going through the massive headache and hassle of converting that to something we would like to have. Even if he would have changed the carpet out, just the first impression was just a awful gut feel. The light industrial that we're talking about investing in today is often like that. It's often got all kinds of disadvantages that we're going to get into. And a professional operator who buys a light industrial property like this can turn it into a professionally run operation and create lots of value for its investors, as you're about to find out. So again, light industrial, 53% of US industrial space, but institutional investment, it's only about 11% of that. Okay, small warehouse spaces are about 90% of the industrial leasing activity, but lower availability and higher rent growth right now. Only 3% or less of the development activity is in the sector right now, yet vacancies just declined in the sector by 6.6%, which means occupancy has gone up a lot since 2010. Here is why there's not much development. Most of the available land in the sector is used for multifamily growth, multifamily development. Multifamily has been so popular. And again, it's called the perfect investment by some, haha. It's so popular that people will, if they have a piece of land or access to a piece of land like that, they'll often build a multifamily, an apartment property on it. So what I'm going to do now that we know, something about what light industrial is, for the rest of this webinar, I'm going to actually use an example of an operator that we've invested with, and then I'm going to show 2 case studies, and then we're going to wrap it up with Q&A. So this operator,
I also wanted to mention that anybody throughout the presentation, if they have any questions, they can put them in the chat or the Q&A. I know you'll take questions at the end, but if they want to put them in there, they're welcome to.
We really hope you'll put in questions, because Ryan and I love to answer questions. So please do. And if you're watching this recording and you want to get hold of us to ask questions, there's going to be an opportunity at the end. So this operator has over 90 people on their team. They've got 45 active light industrial parks, 1,500 tenants, 8.5 million square feet. So this isn't, a massive, multi-billion-dollar institutional operator, but they do have 1.4 billion invested in the space. They've got a 37% realized IRR, that's internal rate of return, since the firm's inception. It's pretty impressive. The key principal's been doing light industrial since the 90s, and he's actually gone full cycle on over 35 light industrial properties. So here's what they're buying. They're buying assets that are cash flowing day one. They have a lot of renovation potential. And we're going to talk about the capital expenditures that are usually not done when they take over these properties. It's got historic occupancy that's trending well below the competitors in that market. They've got a lot of rent growth potential. Oh, by the way, the place I mentioned that was full of junk, it was a very low price. I couldn't imagine being there. I just couldn't imagine being in that space. I didn't like the way the offices were laid out. I didn't like where the conference room was. I didn't like a lot of stuff about it. Well, that's the kind of stuff that a great operator can overcome. And we're going to see how they do it in a minute. These are properties that have a lot of vacancy, have outdated configurations, and they just need some new capital to meet the market demand. And a lot of these, sometimes first or second generation owners, this is sort of a cash cow to them, and they don't want to go to the hassle. They don't want to put in the money. They don't want to take on new debt. They don't want to take on new investors that it would take to really upgrade these facilities. A lot of these, honestly, are pretty famous for having roof leaks. And so, I mean, you can all imagine, what it would be like to go into a space that has a roof leak. And, the owner saying, yeah, I'll patch it when I can, was kind of their attitude. Now, this operator that we're talking about has tremendous diversification. I think this is important to know this as we talk about light industrial today. They've got, apparel companies, they got retail companies, they've got technology, software, life sciences, food and beverage, healthcare, design and marketing. They've got, they even got some office space in there. They've got construction, engineering firms, business and admin. It's just a very wide variety. And manufacturing, which you might have thought of when you heard about light industrial, although it's the largest sector for this particular operator at 12%, it's still, only about 1/8 of the total space is taken up by manufacturing, industrial services, and supplies. So again, we love this diversification. We love diversification in general. When we can get diversification in an individual asset like this, we're even happier. So what's typically needing to be done when our operator takes over a facility like this? Well, here's some typical exterior improvements. They need new paint. They need better signage. They need better tenant signage. They need better signage in general to figure out how to get where they're going. If you've ever been to one of those places where you can't even find the number of the building, lower density landscaping, roofs and HVAC. They need a better parking lot. They usually need new striping, new paving, all kinds of things like this. So here is a modeled picture at acquisition on the top, how the building looks. It doesn't look that bad in this case. But at the bottom, it's got, tenant signs. It's got addresses you can actually read. It's got a restriped parking lot. It's got new paint, new landscaping to replace the 1980s bushes out front. These are typical exterior improvements. As far as interior improvements, reduced percentage of office space is typical. Dividing the units differently in some cases, sometimes custom dividing for that tenant. Polished concrete floors, improved lighting, new or updated restrooms, accent walls. This is an example on the top here. I think this is actually better than a lot of them look, okay? But on the bottom, you can see how it looks after they took it over. They ripped out all those old little boxes here. They put in, new paint, new flooring, just a much better look and feel for renting. So now we're going to jump into 2 case studies, and then we're going to have Q&A. So this one is an actual corporate plaza that was acquired in Arizona. The original owner was reluctant to use modern leasing brochures. They didn't have updated floor plans. They just weren't doing very well. So they immediately established an on-site broker presence, which is what they typically do. They put a person on site in a little office there to help the tenants directly day to day. They increased occupancy from 55 to 100% in, I believe it was 3 years of ownership. The owners were reluctant to make cosmetic improvements, and they did those improvements. They executed, they put in landscaping, and they modernized the paint scheme. They did all types of things like that. They improved the HVAC system, which is extremely expensive, new roof, parking, and they basically made it into an institutional quality asset that might be acquired by a REIT or an institutional. By the way, that's another reason we love this asset class, is these REITs and institutional buyers, they want to buy assets, but they don't want these crummy, outdated, lots of hassle, lots of repairs type properties. And so by going in and acquiring these when they're, mom and pop owned, and making them into a professionally run asset, our operating partner can do a great job. And you can see it's exactly what they did. So they acquired this in April of 2016, sold it in December of 2019, 8.3 million on the front end, $15.9 million sale price. The occupancy we already mentioned went from 55 to 100%. That's without adding any buildings. They went from 24 to 28 units, so they decreased the size of some of those. You can see the picture on the left, at acquisition versus after the acquisition. I mean, it didn't honestly look that horrible beforehand, but it looked better afterhand. So check this out. The internal rate of return, the bottom line on this, was 16.5% projected, but it came out at 26.7%. The occupancy, the NOI, you can look at that. The net operating income alone, 279,900 at the front end, up to 937,000 in just 3.5 years. So quite impressive turnaround. That doesn't just reflect the great asset class. It reflects a great operator who knows how to make great acquisitions. Our last case study before we wrap up is Patrick Commerce Center in Las Vegas. The prior owners didn't want to do the cosmetic changes just like the other ones. They also had 55% occupancy. The new operator went in and spent $1 million making all kinds of improvements to the cosmetics, the HVAC, the roof, the parking, and basically, again, turned this into an institutional level asset. Net operating income on this one was around $562,000, but they took it to over 1.5 million. Took the occupancy up from 55 to 95, and the internal rate of return that was projected at about 18.9%, it actually came out to 36.7%. It's another thing we love. We love to invest with operators who actually underpromise and over-deliver. So that's another example. In closing, if you can find a great operator in industrial, light industrial specifically, an operator that acquires mom and pop type assets, which are very hard to find. And they're pretty hard to get your hands on right now, because obviously industrial has done a great job. Industrial's in the news a lot right now. We can see that from Green Street. If you can find an operator who knows how to execute that strategy, we believe, Wellings Capital believes, this is a great investment opportunity. If you want to learn more, you can get on my calendar to follow up. If you watch this recording, or if you didn't get your questions answered today, You can schedule a follow-up call. You can screenshot this to get information. You can actually go through our e-course for free at the website wellingscapital.com/e-course. If you want reports on self-storage and also mobile home parks and other types of things, you can do that at wellingscapital.com/resources. Or if you just want to chat with us, you can email us at info@wellingscapital.com. So I know that Griffin and Alyssa are on here from my team. I'm sure they're quickly adding questions to the question box. Ryan, do you have any questions, or does anybody else have any questions at this point?
Do you have to be accredited to invest with Wellings?
Yeah. Accredited, and you have to be accredited investor. And if you don't know what that means, you can check with us and we'll let you know. But basically it means you have $1 million in assets, not including your home, or you have individual income 200,000, or filing jointly at 300,000 or more. But yes, you have to be accredited to invest with us.
Do you have a minimum?
Yeah, it's a $50,000 minimum to invest with Wellings Capital in our current fund.
Okay. Someone else asked, what are the risks involved with investing at Wellings?
The risks involved with investing in Wellings Capital are, I mean, the biggest risk in investing, I believe, with any real estate operator is the operator going bad. I mean, and that doesn't mean that they moved out of the country and took your money. It just means that they either did a terrible job, or they have a terrible team, or they got the wrong debt, or, maybe somebody, key managers moved on. Wellings Capital, we saw this as the number one risk in investing in commercial real estate. And so what we've done is we've become sort of like a mutual fund for investors who want to invest in a cross section of commercial real estate. We go out and we do a ton of due diligence on operators. We do everything we can to learn everything we can about them. We do the type of due diligence that individual investors would do if they had the knowledge or the time or the resources to do that. We do that on their behalf. And then we put several operators, several asset classes, and a whole bunch of different assets together in one fund, so people can invest $50,000 and get a cross section of investments. There's no guarantee that we'll do better than anybody would individually in our due diligence. But so far, in the last number of years, we're on our 6th fund right now, and every fund that we've invested with so far, we're very, very happy with where they're going and what they've returned so far to investors.
Awesome. Couple more questions for you there, Paul. You may have said it, but they missed it. They were asking, how old is your company? How long you've been doing this?
Oh, yeah. So Wellings Capital, we started in 2014. Now, I'd already been in real estate. I've been in real estate. I made my first commercial investment in 1999, but I've been in real estate for, about 23 years. Wellings Capital has been around. We started with a different name in 2014. There was kind of a long name that we shortened in 2016 to Wellings Capital. We've been doing the fund model. We kicked off that new model in January 2019.
Awesome. What percent of the new fund is compiled of light industrial assets?
Yeah, so we're in self-storage, mobile home parks, and RV parks. Those are our top 3 assets. We have a lower percentage in multifamily and opportunistic retail and light industrial. We expect at the end of the day that our new fund will have between 5 and 10% light industrial.
Awesome. What are their tax advantages with this type of investing?
If you invest directly, if you directly own a piece of commercial or residential real estate, you can get the write-offs of depreciation. The way we've got it set up, and a lot of syndicators out there have it set up, is that you can get the flow through paper losses from depreciation if you get a K1. And we've got our company set up to provide our investors with a K1. That's the tax return that we provide, and that will show the depreciation losses. Getting the depreciation losses allows investors to have tax advantaged income over several years. And it also allows investors to roll those losses forward a number of years, unless they're a qualified real estate professional. I'm sure some of the folks at CamaPlan are that. If you're a qualified real estate professional, that means you can actually take even greater losses against your ordinary income earlier than you would if you're a passive investor. There's also other tax advantages, and I've actually done webinars on that. If you want to get hold of us, you can learn more about that by getting my commercial real estate e-course that we talked about earlier.
Another one real quick for you. What's your process for choosing these operators?
Great question. We have a 27-point due diligence checklist, and we typically go through between 3 and 6 months of due diligence. We do everything we can. We do criminal checks, background checks, reference checks. We do, a deep dive on them. We do what we call death by Google, where we go around and, put their name and their principal's name and their previous company's names, with every kind of we match it up, with fraud, scam, SEC violation, securities exchange. We Google everything we can to learn all we can about them. And I will tell you that somebody we wanted to invest with recently, one of their principals actually had some charges against them, and we decided not to go forward with them. And so we do a lot of that. We actually we drop in and visit their sites unannounced. We go to their headquarters on a scheduled visit. We see how they talk to their employees. We see how they talk about their spouse and their investors. We see what other investors have to say about them. We do everything in our power to learn everything we can about them. We see what kind of debt they take on. We recently said no to an operator because we thought their debt was too risky. And so we're doing everything in our power to learn everything we can and to make sure this is a recession-resistant investment. We didn't say recession-proof, but recession-resistant to the best of our knowledge.
Awesome. Another question for you. Are you invested alongside the LPs in the fund?
Yeah, I am. So Ben and I, my partner, spent hundreds of thousands of dollars to launch our new fund. And so we invested only $200,000 before anybody else. And I individually and Ben are planning to continue to increase our investments. Now that the fund is up and running, I'm planning to invest $150,000 more within the next month, and hopefully a lot more than that in the next year. So yes, we think that's really important. What's even more important is that the people with their hands on the controls, the people who are actually acquiring these light industrial and mobile home parks, self-storage, that they have invested a lot of their own cash. We walked away from an operator once because this Houston-based operator, it's not somebody anybody would know. It's kind of an obscure company, but we really like them, but they didn't invest any of their own money. And we think that's really important. So that's a really good question. It's something you should be asking.
Awesome. Well, I appreciate your time. I don't see any other questions at the moment, but again, if you do have any other questions, reach out. You have the website there. And if anybody needs information concerning how to use, retirement accounts, get a hold of me. You can go to our website, camaplan.com. And thanks again for being with us, Paul. Much appreciated.
Thanks, Ryan. Thanks, everybody.